So you're scrolling through financial news and you see another headline: Gold hits all-time high. Then another: Silver surges 15% in 3 weeks. You check the price of gold. It's over $2,700 per ounce now. Silver is pushing $35, and you're thinking, didn't my grandpa tell me to buy gold years ago when it was $1,200? Why didn't I listen? But here's what's really bothering you. You have no idea why precious metals are suddenly exploding. Everyone's talking about it. Your uncle's buying silver coins. Your coworker just opened a gold IRA. And you're sitting there wondering if you should jump in or if you're just chasing the latest hype. Here's what nobody's explaining. This isn't random. This isn't hype. There are four specific forces happening right now that are pushing precious metals prices higher, and understanding them is the difference between making a smart move and getting caught in a bubble. Hi there, my name is Dan, and I spend way too much time thinking about why assets that have been boring for decades suddenly become the hottest investment, and whether that means you're early or late to the party. If you're someone who's watching precious metals skyrocket and trying to figure out what's actually happening and whether you should buy some, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, the first thing you need to understand is that gold and silver aren't going up. The dollar is going down. This is a mental shift most people never make. When you see gold go from $2,000 to $2,700, you think gold is more valuable now. But that's backwards. Gold is the same. An ounce of gold is still an ounce of gold. What changed is the dollar became worth less, so you need more dollars to buy the same amount of gold. Here's the analogy that makes it click. Imagine you're in a currency exchange booth at the airport. The euro to dollar rate changes every day. When the euro goes up against the euro didn't become more valuable. The dollar became less valuable relative to it. Gold and silver are just currencies that governments can't print more of. When governments print dollars like there's no tomorrow, those metals go up because the measuring stick, the dollar, is shrinking. According to the Federal Reserve's own data, the M2 money supply, basically how many dollars exist, increased from $15.5 trillion in 2020 to $21.7 trillion by 2022. That's a 40% increase in the number of dollars in just 2 years. When you flood the system with 40% more dollars, each dollar becomes worth less. Gold doesn't care. It just reflects that reality. Here's what most people don't realize. The biggest buyers of gold right now aren't individual investors or jewelry makers. They're central banks. The same central banks that print money. Think about that for a second. The people who control the printing presses are buying gold. What does that tell you about their confidence in their own currencies? According to the World Gold Council, central banks bought over 1,000 metric tons of gold in 2023, the second highest level ever recorded, and they're not slowing down. China added to its gold reserves for 18 consecutive months. India, Poland, Singapore, Turkey, Czech Republic, all stockpiling gold. Why? Because when you're a country, you need reserves that other countries will accept. And when trust in the dollar or euro wobbles, gold is the universal backup plan. Now you might be thinking, but isn't the dollar the world's reserve currency? Why would they need gold? Here's where it gets really interesting. The dollar is the reserve currency today, but central banks are diversifying away from it. According to the International Monetary Fund, the dollar's share of global reserves dropped from 72% in 2000 to 58% in 2024. Countries are hedging. And when countries hedge, they buy gold. When demand from the biggest buyers in the world increases while supply stays relatively flat, prices go up. Basic economics. Look, the official inflation numbers say everything's fine. Inflation is under control at 3%, but your grocery bill says otherwise. Precious metals thrive when people lose faith in the purchasing power of their currency. And whether the official number is 3% or 7%, regular people feel like their dollars don't stretch as far as they used to. Here's a concrete example. In 2019, a dozen eggs cost about $1.40. In 2026, they're about $3.20. That's a 129% increase. Gas went from $2.60 to $3.80 per gallon, a 46% increase. Your rent probably went up 30 to 40% depending on where you live. Your dollars are buying less, a lot less. And when that happens, people look for stores of value that can't be inflated away. Enter gold and silver. But here's what makes this different from past inflation cycles. The debt situation is completely unsustainable. The U.S. national debt is $36 trillion and climbing. We're adding $1 trillion in debt every 100 days now. There are only two ways to deal with unpayable debt: default on it, never happening, or inflate it away by printing money and making the debt less valuable. Guess which one they're going to choose? When people realize that inflation isn't a temporary problem but a permanent feature of the system, they start moving assets into things that hold value. Historically, that's always been precious metals. Every time the world gets more uncertain, gold goes up. It's been that way for thousands of years. Right now, we've got ongoing conflicts in multiple regions, trade tensions between major economies, elections causing policy uncertainty, banking system stress. Remember Silicon Valley Bank? Supply chain fragility, debt ceiling debates that threaten government shutdowns. When things feel stable, people invest in stocks and real estate. When things feel chaotic, they move to safe havens. And precious metals have been the ultimate safe haven for literally 5,000 years. According to a study by the London Bullion Market Association, gold prices have a 0.8 positive correlation with geopolitical risk indices. Translation: when geopolitical risk goes up, gold goes up almost in lockstep. This isn't superstition or coincidence. It's human psychology. When people are scared about the future, they want to own something that's been valuable through every crisis in human history. Something that can't go bankrupt, can't be hacked, can't be defaulted on. Here's something that doesn't get talked about enough. Mining precious metals is getting harder and more expensive. According to the Silver Institute, global silver mine production has been relatively flat for years while demand keeps increasing. Solar panels need silver. Electronics need silver. Industrial applications need silver. But new mines take 7 to 10 years to develop, cost billions, and are subject to environmental regulations that make them harder to build. Gold is the same story. The easy gold has been mined. What's left requires going deeper, which costs more, which means higher break-even prices. So you've got supply that's flat or slightly declining, demand that's increasing from central banks, investors, and industry, production costs that are rising. When supply is constrained and demand is increasing, prices go up. This is economics 101. But here's where it gets really interesting. Unlike stocks or real estate, you can't just create more gold or silver when prices go up. The total amount mined each year is limited by geology and physics. There's only so much in the ground, and extracting it is expensive and slow. This supply constraint means that when demand surges, prices can move violently higher because there's no way to quickly increase supply to meet it. This is where most people mess up. They see precious metals going up and they think, I should buy some. But they don't actually understand why they're buying it, so they panic and sell the first time prices dip. Here's the mental framework you need. Precious metals aren't an investment, they're insurance. You don't buy homeowner's insurance hoping your house burns down so you can collect. You buy it hoping you never need it, but knowing it's there if something goes wrong. Precious metals are insurance against currency devaluation, government mismanagement, banking system failures, geopolitical crises, loss of purchasing power. When you frame it as insurance, the question isn't, will precious metals make me rich? The question is, what percentage of my assets should be in insurance? According to research from Ray Dalio and other institutional investors, 5 to 15% of a portfolio in precious metals provides optimal risk-adjusted returns. Not 50%, not 100%, but enough that if things go wrong with traditional assets, you have a cushion. All right, here's the practical framework for whether and how to buy precious metals in 2026. Question 1. Do you have your financial basics covered? If you don't have an emergency fund, if you have high interest debt, if you're not investing in retirement accounts, fix those first. Precious metals come after you've handled the basics. Question 2. Are you buying for the right reasons? Wrong reason. It's going up, so I want to make money. Right reason. I want 5 to 10% of my portfolio in an asset that protects against inflation and currency risk. If you're chasing gains, you'll buy at the peak and panic sell at the bottom. If you're building insurance, you buy consistently and hold. Question 3, physical or paper? You can buy physical coins or bars. You hold them. ETFs like GLD or SLV, easier to trade, but you don't own the actual metal. Mining stocks, leveraged bet on metal prices, but higher risk. For most people, a combination makes sense. Some physical for the psychological benefit of holding it, and some ETFs for liquidity and ease of trading. Question 4. How much should you allocate? Conservative, 3 to 5% of investable assets. Moderate, 5 to 10%. Aggressive, 10 to 15%. Never more than 15%. Even the most bullish precious metals investors don't recommend more because you need diversification. How to actually buy? Start with dollar cost averaging. Don't dump $10,000 in all at once. Invest $200 to $500 per month consistently over 12 to 24 months. This way you buy some at high prices, some at low prices, and you average out the volatility. For physical metal, APMEX, JM Bullion, or local coin shops. For ETFs, GLD, gold, SLV is silver, through any brokerage. For mining stocks, GDX, gold miners, SIL, silver miners. Look, I can't tell you if gold is going to $3,000 or $2,000 next year. I can't tell you if silver is going to $50 or back to $20. Nobody can. What I can tell you is why precious metals are rising right now. Central banks are hoarding. Inflation is structural, not temporary. Geopolitical uncertainty is increasing. Supply is constrained while demand is growing. These forces aren't going away next month. They're long-term structural shifts in how the global financial system operates. Does that mean you should buy precious metals? Only if you understand you're buying insurance, not a get-rich-quick scheme. Only if you can allocate 5 to 10% of your portfolio without it affecting your ability to pay bills. Only if you're prepared to hold for 5 to 10 years regardless of short-term volatility. The worst thing you can do is ignore precious metals completely because you don't get them. Then panic buy at the peak when gold hits $4,000 and everyone's talking about it. Educate yourself now. Make a rational decision. And if you decide to buy, do it systematically with money you won't need to touch. Hit that subscribe button if this finally explained why precious metals are moving. Drop a comment telling me if you own any gold or silver and why. And share this with someone who's been asking you why metals are suddenly going up. They're not suddenly going up. The forces have been building for years. You're just noticing now. I'm Dan, and I'll see you in the next one.